Welcome to our detailed comparison of VOO and VOOG. VOO is a Vanguard index fund that aims to track the performance of the S&P 500 index. It offers exposure to large-cap US companies. VOOG, on the other hand, is an ETF that also tracks the S&P 500 but focuses on growth stocks within that index. Both funds offer a convenient way to diversify your portfolio with a single investment, but they differ in their approach, expense ratios, and performance. Expense ratios are a crucial factor when comparing ETFs. VOO has an expense ratio of 0.03%, which is incredibly low. This means that for every $10,000 invested, only $3 goes towards fund expenses. VOOG, on the other hand, has a slightly higher expense ratio of 0.10%. Therefore, for every $10,000 invested in VOOG, $10 goes towards fund expenses. While this difference might seem small, it can add up over time. Performance is another key factor. Over the past decade, VOO has had an average annual return of around 14%, while VOOG has had an average annual return of around 15%. While VOOG has slightly outperformed VOO, it's important to remember that past performance is not indicative of future results. Both funds have had years where they underperformed or outperformed the other. VOO holds all companies in the S&P 500 index, providing broad exposure to the US stock market. VOOG, however, focuses on growth stocks within the S&P 500, making it less diversified. VOO holds around 500 stocks, while VOOG holds around 300. This difference in holdings can lead to different risk and return profiles. VOO has a higher dividend yield compared to VOOG. As of now, VOO's dividend yield is around 1.3%, while VOOG's dividend yield is approximately 0.9%. If you're an investor who relies on income from dividends, VOO might be a better option for you. Both VOO and VOOG have similar risk levels as they both track the S&P 500. However, because VOOG focuses on growth stocks, which tend to be more volatile, it may be slightly riskier than VOO. It's important to consider your risk tolerance when deciding between these two funds. Both VOO and VOOG are exchange-traded funds, meaning they can be bought and sold throughout the trading day at market prices. Both are also accessible to individual investors with no minimum investment requirements. However, the price per share varies. VOO's price per share is typically higher than VOOG's. Both VOO and VOOG are managed by Vanguard, a company known for its low-cost index funds and ETFs. Vanguard has a strong reputation for its investor-friendly practices and commitment to keeping costs low. Therefore, both funds benefit from Vanguard's expertise and management. Choosing a winner between VOO and VOOG depends on your investment goals and risk tolerance. However, VOO edges out VOOG for several reasons. First, VOO has a lower expense ratio, which can save investors money over time. Second, VOO offers broader diversification, with exposure to all S&P 500 companies. Third, VOO has a higher dividend yield. Lastly, VOO's share price is typically less volatile. VOO is ideal for investors seeking broad exposure to the US stock market with a focus on low costs and dividends. VOOG is better suited for investors willing to take on slightly more risk for the potential of higher returns and who are less concerned about dividends. In conclusion, both VOO and VOOG are solid investment options, each with their unique strengths. Your choice between the two will depend on your individual investment goals, risk tolerance, and preferences for diversification and dividends. Thank you for watching our comparison of VOO and VOOG. If you found this information helpful, please like this video and subscribe to our channel for more detailed investment comparisons. We appreciate your support and look forward to helping you make informed investment decisions.